This session is sponsored by Porter Hedges, the informed choice.
Jason Martinez spent 18 years as a Wall Street investment banker, not all of that in energy, and most recently spent the past couple of years as head of BMO's U.S. A&D business. Today, he'll be speaking about some of the trends he's observed in the M&A market. Jason, welcome.
Look, I've got a packed agenda. If you look here on page 1, as Darren mentioned, I want to go through the commodity price and investment cycle and really talk about what we're going to see on supply demand, talk about where capital markets are and the M&A outlook. And as a bonus, I've included a business development plan. Spoiler alert, I think that the M&A environment is going to look a lot different in 12 months than it does now. I think it's going to be a lot more robust. Just a quick context on me. Been blessed with a really great career, really rewarding over the last 25 years working with boards and management teams on the most pivotal parts of their life cycle, the most pivotal times in their life cycle. Done capital raising and mergers and acquisitions. And so a lot of the perspectives that will follow in this discussion are based off that. So on the next page, I thought it would be good to look back 10 years. I think we often forget some of the history. So I'm going to spend a little bit of time just setting some context on commodity prices. So, about 10 years ago, we were bouncing between $80 and $100 of oil. And gas was somewhere between $3 and $5, peaking to $5 at some times. And what this did was this allowed for a tremendous amount of innovation and drilling innovation and investment. Over the last 6 years, of course, though, the volatility has been really pronounced. And arguably, we've had two mini down cycles with, of course, the big repricing last year. So today we sit around the mid 50s and $3 for the 12-month strip, but into a backwardated, context. So makes it hard to plan. On the planning front, you can see the underinvestment that's been going on really since the volatility was introduced into the market. Peaks of rig activity in late 14, a big rundown of that. You saw an 80% decline in oil rigs and gas rigs. During that period, and then a recovery, which took us back to almost another little peak here. We didn't know it at the time, but 2018 was another peak. And so, of course, we've gone back down. And so today we sit at somewhere south of 400 rigs. What's interesting, though, is that on page 5, given the advancements in drilling and completion technology, AI and machine learning are a bigger part of the rig and field environment. We were able to produce a lot more with a lot less, and of course, we were drilling the best wells around. And so you can see that in this chart, and it takes us through really the 2018, 2019 environment. But here's the problem: if you go to the next page, we look at decline rates, and this chart before was at around 1,000. Rigs, if you look at it, not our current sub 400. So this is structurally too low, this kind of rig count to stave off declines. Now, my former partner, Morgan Luker, who was BMO's lead engineer, total superstar, by the way, she architected this data analytics platform. And so we use a bunch of different data sets from DI to the Bureau of Economic Geology, our own native data sets. We applied Python algorithms and used Spotfire to really understand every well in every major basin and how it declined, to really look and understand what would happen at any given period over in any given basin. And so as we looked at it, you can see anywhere from 25 to 30% decline rates. And frankly, on the ground, probably a lot steeper. And Morgan and I would have a lot of vigorous debates about that. The reason, of course, is we drilled the best wells first. The next set of wells, as we continue to drill through our tier 1 and acreage, is going to continue to probably have steeper and steeper declines, but just a representative. So again, we were at 2,000 rig count, then we were at 1,000, now we're at 400, but we're fighting this massive decline rate. So still talking about supply. So this is a slide from my friends over at Flow. So Michael Frieso and Tom Lowry are really putting together a very clear-sighted platform using a lot of AI and machine learning analytics. And what they're doing is working with institutional investors and increasingly operators to give them a lot more transparency into what's going on in the field,